Welcome back. You're watching Money, Money, Money. And this week we are talking all about debt mutual funds, fixed income investing. What do you need to keep in mind as 2018 rolls on and as these interest rates continue to be fairly volatile? Amit, so I'm going to flip the question around. I completely understood your point that first you need to set your time horizon. But there are a lot of people who have surplus money on the side. I mean, the same people who are doing FDs because they don't know what else to do and they don't want to put all money in equities. So there's surplus money. It's not required in the next 6 months. It's not required maybe the next 1 or 2 years as well. For this category of people, which funds would you go with now?
Okay, I completely agree with you because most of the times the error that I've seen investors making is actually they really don't know the kind of time horizon that they are coming in with. Okay, and you always tend to underachieve because of that. You know, you might have 1 year money and 2 year money lying in a liquid fund kind of a product, and in an ultra short term fund kind of a product because people just think about it as temporary surpluses, don't really plan for it, and that money keeps on lying along, and you know, it's a suboptimal kind of a return. So if you are not very sure of your time horizon and you know, but it could be 6 months, 12 months, 18 months, 24 months, the least that you can do is at least come into a neutral duration kind of product and not be very, very short in terms of duration because there is an element of reinvestment risk, there is an element of carry in a steep yield curve. You tend to miss out on both in case you are making that mistake.
So explain what do you exactly mean when you say neutral duration and which particular funds would, let's say from your stable, from your universe, which funds would fall under this category of neutral duration?
So a short-term bond fund would fall in that category. Accrual fund would typically fall in that category. These are products which typically, not only for us, but industry-wide, these would typically be running a duration profile of between 1.5 to 3.5 years, ballpark.
And Vijendra, your thoughts on this? For someone who doesn't have a particular time frame in mind, has extra cash, is willing to invest as long as he gets good returns.
I think if they are comfortable with, so accrual also is construed as lower credit, typically. Okay, so if you are, another point of even when I spoke about liquid fund return at 30 basis point and ultra short at around 30-40 more from there, it was a high grade, high quality product. But if you're talking about if you're comfortable with credit and you're comfortable with the fund house, the way they do credit, I think accrual funds in shorter duration also serve very well for an investor. And they give you almost about 100 basis point more than what a typical ultra short term fund can deliver.
So if in today's environment, if you're talking about a normal accrual fund, what should we expect? 7.5?
This could be easily about taking the volatility also into account. 7.5 is something which it can deliver in about a year's time.
1 year, average return of
average in 6 months to 1 year.
6 months to 1 year. Similarly, for the short-term bond funds that we discussed, what would be the average, realistic return expectation be?
So investors, if they stay for 1 year and beyond, should typically expect at least 50 to 75 basis points over what a liquid fund would earn.
Okay, gentlemen. So now as we come down to final thoughts, I'm going to ask each of you to pick out from your gamut of funds, and you manage so many of them. You at Reliance and you at Sundaram. The 2 or 3 funds, if you were to park your own money or if you were to tell me to invest my money, then which are the 1 or 2 or 3 funds from your own stable that you would go with as we look at 2018?
So from a high quality perspective, in the short-term category fund, we have Sundaram Select Debt Fund, which I would recommend. It has done pretty well. And going forward also, the idea is to manage the interest rate cycles there. Manage it from the interest rate side rather than from the credit side. While on the other spectrum, we have in the ultra short category a little bit higher accrual fund, which is Sundaram Income Plus Fund, which I would recommend people to hold these 2 funds in this kind of environment at this point. Probably we will revisit again as the interest rate environment changes.
Absolutely. Okay, fair enough. Amit, same question to you. So you have a galaxy of funds. Looking at the market, looking at the environment right now, if you were to advise me or put your own money, then where would it go?
So if you have money, so be for less than 6 months, stay invested in Reliance Money Manager Fund, which is an ultra short term category product. If you have money for 1 year and beyond, the 2 funds which would work best in the environment would be Reliance Regular Savings Fund Debt and Reliance Corporate Bond Fund.
So Reliance Regular Savings Fund, what sort of paper does it hold? What's the mix there?
So typically it invests across private sector credits, across the rating profile. and has a discipline of running duration of 2 years or below at all points in time.
Okay.
So it's a typical carry-oriented product. Corporate bond fund invests across private sector credits, but there we have a restriction in terms of not going too low in terms of the risk profile. Typically would invest more into the AAA and AA space. Benefits more from improvements in corporate balance sheets, cyclical upturns in the economy, and also in that sense gets a lot of help through spread compressions.
And as an aware investor and not a greedy one, what should be my return expectation, let's say, from the corporate fund?
So in the current environment of interest rates, irrespective of which fund you are looking at, I don't think investors should be expecting more than 7.5 to 8% return over a 3-year kind of a time horizon.
This is including the tax efficiency, or no?
No. I'm talking about
just the fund return.
Post-expense returns.
Okay.
And if you are talking about shorter time horizons, then you have to bring down your return expectations a bit.
Okay. All right, gentlemen, very helpful conversation. Thank you so much for taking out the time and enlightening and educating our viewers on how to go about building their fixed income portfolios. Thanks very much. We wish both of you a great 2018 as well. That's it on this episode of Money, Money, Money. Your feedback, comments, queries are welcome as always. We'll see you again next week.